The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.
Welcome to How to Money with Cole and Cole.
I'm Cole.
And I'm Cole.
We coach people every day on their money and how to plan for the future.
As financial advisors, we're here to have an honest conversation on investing, retirement, and everything in between.
At Full Swing Financial Planning, we're here to empower you to take control of your plan, your way, for your financial future.
So let's talk money.
And sports.
Welcome back to How to Money with Cole and Cole. I'm your host, Bailey, but I'm excited because the gang's back.
Yeah, we're all here.
The
We're
band
all
is back together.
I love it. How is it going, guys?
Well, it's been an interesting spring. That can be, to say the least, with the market volatility recently.
It's like the weather, unpredictable.
Yep.
Very.
Yeah, Iowa weather.
Yeah,
Market's like Iowa weather. There
Yeah,
you go.
yeah. One day it's sunny and the next day it's
Especially
cold.
in spring. Especially in the spring. Well, it's going to be, we had snow a couple weeks ago. We're going to, we also had 80s, and we're going to have 70. It's supposed to be pretty nice this weekend. We look like we're trending up.
Yeah.
So,
Yeah, it's all good.
market's back up today after, we're recording this on Tuesday, the
April 8th.
April 8th, and last week we had some,
We had a little downturn.
We've had a few phone calls.
a few phone calls, which is to
Not
be
at all.
expected.
That's what we're here for.
Yeah.
To be expected, but it's for as emotional as it can be. It's part of being a long-term investor and part of being an equity investor is we're going to have times of uncertainty, and
It's been good for too long.
I'm looking forward to our conversation today, talking a little deeper into this. So
We have a really, really great guest. He's been on much bigger shows than ours.
Yeah.
but-
Oh, come on.
I feel
Our
honored
show's
to have
pretty
him
good.
on.
I mean, we have a lot of followers listening. I'm just saying.
He's been on Bloomberg.
Well, yeah,
and all
yeah.
kinds of
CNBC,
stuff.
like
Yeah.
a lot of stuff. So so our guest Scott Ladner, Chief Investment Officer, Horizon. He'll go. I love their strategy. I mean, it's actually made for like this type of market volatility and uncertainty. So it's gonna be really exciting to cherry pick his brain and kind of hear his insights on what's going on.
It's really made for people that are in those stages, pre-retirement and in retirement, and that's why we tend to use it, because obviously we work with a lot of those people, and so he'll talk about the different stages that they have, but it's something that we use, so that they're an extension of our office basically. Like I flew out to North Carolina and met with their team, and we use their investments for our clients. So we don't necessarily pick and choose the different stocks, bonds, mutual funds that they do it for us, but we meet with them and talk about their strategies and why we should be using them and who we should be using them for.
And we used to think of, I don't want to say like back in the day, but when people traditionally used to get started investing, let's say 20, 30 years ago, they'd pick a mutual fund, right? Mutual fund, and that's what it was. And there was a manager inside that mutual fund that's buying and selling the stocks, doing all that. You never saw that though. Now the investment world's really changed to where we're able to really own our own strategy, or almost like owning your own mutual fund, where we hire a manager, or we partner with a manager like Horizon. They maybe will manage a piece of your portfolio for us and get that real customized, professional management based on, the goals and outcomes we're trying to achieve with that account.
And I'm glad you elaborate on that, because I think we use that term money manager all the time, right?
Very loosely, right? Like everyone should know what that is. Right?
Yeah, and that was a great example. Like the person used to manage the mutual fund, but now we get to work with these people who this is what they do day in, day out. They understand the market better. They're managing this portfolio, and they are a goals-based manager. So let's bring Scott on. We are here with our special guest, Scott Ladner, Chief Investment Officer at Horizon Investments. Scott, thank you for being here. Thank you for your time. I know it's precious. You are with Horizon Investments, a firm known for goals-based investment strategies. Kind of tell our listeners your background, how you got to Horizon, how you became the CIO of Horizon.
Yeah, sure. Look, first of all, appreciate you guys having me on. It's an honor and a pleasure to spend a little time with you, and your clients and listeners. So my story's a little bit goofy. So I came out of school. I went to UNC, North Carolina, Chapel Hill, and I got a majors in Russian and economics, which is an odd double major, but that's what I ended up getting. Like long story short, I thought I was going to get a PhD in economics at Chicago. That was sort of the plan. But then I took an interview at what was then First Union Bank down here in Charlotte on the Dritta's desk when I was a senior. And it was a 16-hour interview. It was a long, drawn out. Sort of the point of it was to try to break you a little bit. But I just loved it. I had a blast. And I ended up they offered me a job, and so I ended up taking it. So the first basically the first like 6 or 7 years of my career, I was a vol trader. So I was a derivatives and volatility and sort of options trader, both on for equities and then eventually on the interest rate side. And so that taught me a lot about obviously the quant stuff and volatility and risk and managing rather large portfolios of complex instruments. I did that for a bit. I ended up starting my own hedge fund. Had to end up suing my partner because he embezzled money out of that. That was a whole big long story. But the end of the story is I ended up at Horizon because I ended up having a joint venture with Horizon on a risk mitigation system. So my hedge fund and Horizon were basically joint partners in this thing. And through that entire process, I ended up finding a group of folks that were really smart, really passionate. Fundamentally nice people, which is as you grow in this industry becomes more and more important, obviously, and just wanted to win. And so I ended up kind of just folding the fund and folding my business into Horizons back in 2010. And essentially led their efforts on the basically designing protection strategies, risk mitigation, hedging strategies, those types of things. That was kind of my main focus at Horizon for a bit, and then in 2016, I got named Chief Investment Officer. So I've been that for however many number of years that is, 8 or 9 years, something like that. And it's we've grown. When I joined the firm, we were managing about $100 million. Today we're just a little south of $10 billion. And we've grown from employees from about 20 to 75, and we're still hiring on the investment side. We still are launching. We're launching active ETFs right now. We're doing custom sort of tax managed, separately managed accounts, which is a big growing business for us. I think we have a pretty clever little tax loss harvesting program that's based on some option math and option theory that we developed internally. And it's all in furtherance of being a goals-based investment manager. Being a goals-based investment manager, fundamentally, what that means is we're designing investment strategies for people rather than institutions. And the chief thing that changes when you decide, hey, listen, I want to start managing money for folks. I want to manage money for mom. I don't really care about mom's pension plan, even though there's much more money in mom's pension plan than there is that mom's got. I think it's more important and actually, frankly, more fun to manage money for individual people. And the primary thing you got to get right when you make that switch, and this is something that I wrote a paper on a number of years ago, is you have to intentionally incorporate the concept of time in the investment process, because obviously people have a timeline associated with them. Things like pension plans, ideally if they're managed properly, don't. The something really fundamentally changes when you incorporate this concept of time in the investment process. Is you realize that, listen, mom's portfolio should be doing something very different when she's 25 years old than when she's 75 years old. That's just another way of saying that the primary objective for mom's portfolio changes as she walks through her life. And as that primary objective changes, then the primary metric of risk that we have to use to define risk also has to change. And at its core, all investment management is maximizing an objective or returns for some unit of risk. And so when we're doing goals-based investing at Horizon, what we're really just saying is, listen, we think there's different definitions for somebody's objective and for somebody's risk as they walk through their life cycle, and you have to manage the money and build the systems, according to those different definitions. But that's really all it means. But it is it's a fun place to work. We're doing a lot of kind of fun, cool, innovative stuff, I think. And it's I look forward to the next 10 or 20 years.
Scott, there's a lot to unpack there. I'll come back to you majoring in Russian. No, I'm just joking. Yeah, thank you for introducing yourself and giving us a little background on Horizon. Talk about the goals-based strategy a little bit, about how what goals are you trying to solve for and how you guys go about that.
Yeah, so look, we think there's basically 3 goals that folks have through their life. We at Horizon, we have a nomenclature. We call them gain, protect, and spend. But the idea is really at some point, especially when you're young, the primary thing you need to be doing is building your nest egg. you have to be accumulating wealth. You're going to be saving and investing properly and all that kind of fun stuff. And so, it's really that first stage of life as we're sort of building our wealth. The main objective for those portfolios and the way we think about them is just like everybody else. We're just trying to maximize the gains. We're trying to maximize accumulation of assets. And so, those are strategies that are designed around that objective. As we move in towards kind of like that pre-retirement period, and it doesn't have to be retirement, but it could be like, hey, I want to buy a boat, or I need to put the kid through college, or whatever the kind of the goal is. As you approach that goal, you're exposed to a slightly different type of risk. You're exposed to more of a funding shortfall kind of risk. And so, the primary objective for those portfolios, shifts from, primarily the thing I need to do is make money, to the primary thing I need to do is protect money. I basically need to put a kind of a floor underneath the portfolio. Because the risk of undercutting that shortfall, like not having enough money to fund whatever the goal is, whether it's retirement or the boat or the kid's college or whatever, that's extreme, and it's extremely asymmetric. It is it's very damaging to miss. It is very good to make it. And so the way those portfolios are managed in a way that's trying to maximize the amount of protection that we can generate while still getting gains if they're available. So that's sort of the second goal. So making money is the first goal. So the second goal ends up being protecting money. And then the third goal, eventually, like ideally, you get to spend it. So we get to spend the money, and that goal carries with it a very specific kind of risk in terms of not necessarily volatility induced risk. Like we don't think about risk in the retirement spending stage or the spending stage of life as being primarily volatility centric, like many sort of traditional risk management approaches do. We really think about the risk for that person spending money is not having money to spend, running out of it. And so if you define the problem that we're trying to solve for that for that retired person or for the person spending money, we're trying to maximize the amount of money they can spend relative to the risk of running out of it. And if that's the problem you're trying to solve, I'll tell you guys, the most dangerous investment you can make, like the riskiest investment in your portfolio, if that's the problem you're trying to solve, is bonds. Now that's antithetical to the way that a lot of folks think about the world. A 75-year-old person with no bonds in their portfolio, people generally think of as an incredibly risky portfolio. And I would just counter as saying, what's the problem you're trying to solve? Because if you're trying to solve a longevity problem, if you're trying to solve a spending money problem, especially in an inflation-adjusted sense, then I would say, listen, if you have a 100% bond portfolio, if you have only bonds in that portfolio, that's the riskiest thing you can do. Because I can tell you to the day on which that portfolio is going to run out of money. I can tell you the day. So you better not live past that. And so the way that the way those programs work is we have definitely an equity sort of centric approach to those portfolios. There's still it's risk managed equity, it's not just straight equity. But at the end of the day, those portfolios are built and constructed according to the way we think about philosophically the problem. And the problem again is I want to spend as much money as I can and minimize my chance of running out of it. And if that is the problem we're trying to solve, you're trying to solve, then I would suggest that we probably need to think about a different approach than sort of a bond heavy approach to those portfolios. I know it's a little bit different, a little bit goofy, but and that's why I spend the most time on it when we're talking to folks. But that is sort of the crux of how we think about the goals based investment strategies.
I want to dig into that a little deeper. I was thinking, this is real relevant right now, market volatility, but behavioral risk, and thinking like the emotional side, how do you, I guess, how would you coach, and I know you're an chief investment officer dealing with advisors. We deal with clients, you have clients, thinking that urge to sell or get out of equities, how do you think about that or talk about that? Or if you hear a client saying, hey, I want to sell and go to bonds when the market gets real choppy.
We address that primarily through information, through transparency. And so, our risk mitigation techniques and programs all have a daily dashboard essentially, where we can tell people, hey, this is what's going to happen. If the market is down or if your portfolio is down this much, we're going to take some action. And here's exactly what that action is going to be. And then on the other side, which by the way, getting out of the market is the easy part of risk mitigation.
Yep.
The hard part is getting the get back in decision, right? As we all know. So we can tell everybody on a daily basis what has to happen in the portfolio in order for them to get out, But just as importantly, what has to happen to get back into the market, to get reinvested, which is by far the harder investment decision. And so we solved that. We really try to solve that problem with transparency, with data, and with a concept that we call expectational certainty. And expectational certainty really kind of like weaves through everything that we try to do. I try to say, listen, if in an up market, a down market, or a sideways market, or whatever's happening in the markets, I can tell you what's going to happen in these portfolios with a reasonable degree of precision. And that's broadcasting that to somebody and telling them this is what's going to happen, this is what to expect, this is the actions we're taking, this is why we're taking them. Just that clarity of knowledge and the bringing some certainty into what feels like an incredibly uncertain environment right now. It is incredibly uncertain. I mean, I'm doing our live webinar here in a few hours. Usually I'm done with a deck that I'm going to be presenting and talking through 5-6 days in advance, 4 or 5 days in advance, something like that. And I might tweak it coming up to it, but it's fundamentally sort of like really kind of there. I've completely redone it in the last 2 days. I had 30 slides.
It can change in the next hour, right? Right now with news, the news cycle.
And we're ripping this thing up live, and it's like, because that's the environment we're sitting in. But clients don't have to feel that. We can project. We can give some sort of certainty based on the strategies that they're using about, like, hey, we don't know what's going to happen, but if this, given what here's some scenarios, and here's how your portfolio is going to respond. Here's what we're going to be doing for it. And that's I think that clarity and that certainty just helps drive down sort of the emotional reaction. Of just, I'm scared, I don't know what to do, I don't understand it, I'm getting out, which is obviously dangerous.
Let's go that direction, since we're talking about the uncertainty. Given the recent market fluctuations, obviously last week, Thursday, Friday, super big drawdowns in the major indexes. How is Horizon looking at that? Obviously, I know the strategies are more predictable, right? You're talking about that predictability on, hey, you kind of know where things are trending with the strategy you have. But how should individual investors, maybe not just in Horizon strategy, be looking at the recent market volatility?
As a reaction to policy uncertainty. So, look, we and if I doubt anybody's been listening to me for the last couple of years, but for anybody that did, we never saw. I never saw a recession coming. We've never seen the recession. We always thought things were going to power through. We had good reason for thinking so. I won't belabor all that stuff now. I'll tell you right now, the thing I'm going to be saying in a couple hours is base case is probably recession now, because what we've got is just an unbelievable amount of uncertainty in the planning of how businesses have to plan through an economy. We are ripping up supply chains again, but we're doing it intentionally this time. Unlike the COVID supply chain disruptions, this is a man-made supply chain disruption event. And so that if I can't import from anywhere, and these tariff levels are making it impossible to import from anywhere, in reality, and still run a business that's profitable in the United States. Then what do I do? I don't know what to do from a business standpoint at that point. And so the point of uncertainty, the point of policy uncertainty, is it just makes you just hunker down and not do anything. And if everybody does nothing all at the same time, that is definitionally what a recession is people hunkering down and not doing anything. So the thing which caused, what you always have to figure out in any sort of big drawdown, any sort of event or crisis, is what's the root cause? What is the root cause of what is going on? What's causing this drawdown? What's causing the volatility? What's causing all this kind of crap to happen? And in this case, and every one in the past, you can always identify what it was. And the key to getting it right, trading it or investing through it or managing through it, is identifying what the root cause was, then identifying the inflection point at which you understood that it is getting better. Now we got some clarity on it. So in financial crisis, it had to do with funding levels and banks, and the .com thing, it doesn't matter. I won't go through the history of it. The root cause for this one is policy uncertainty, because we don't know what's coming next. We don't know what these tariff levels are going to be. We don't know how long they're going to be there. We don't know what the reaction function is for different governments, different companies around the world about how they're going to kind of respond to this. So until or unless we get some policy clarity and some certainty about what the future looks like from the rules of the game standpoint, this can't really get better, and which is frustrating. It's frustrating. It's I could not be more frustrated right now. Because these are voluntary choices that we're making on the policy front to inject this amount of uncertainty. And irrespective of anything else, I evaluate policies. I don't evaluate people or politics. I care about the policies. These policies are injecting an amazing amount of uncertainty into a system that was pretty darn good. The economy was fine. Like we weren't humming like we were a couple years ago, but it was pretty good. It was a 6 or 7 out of 10. And now it's not. So, the thing that we're focused on, and the way I tell investors sort of, analyze this or think about it, is think about what the root cause was. In this case, it's policy uncertainty. And when we can see through that, when we get a little bit of clarity about it, and it will come eventually. This is going to go on forever. When we can get some clarity on that, like that's when we're going to kind of really rock and roll again. But it's literally impossible to rock and roll again until we get until we clear what the primary problem was. And so like that's what we're just all waiting on right now. Like it'll come. We're just not there We're just not there as of 11 a.m. on April 8th.
Seems to be the consensus, with everyone, I always relate to like media or people on TV or commentary, anyone that's putting out economic content, it's all different, right? There's no, status quo or, hey, here's where we're trending. No one's given a real consensus answer.
So as you've said, you guys are focused on mom, right? You're on her investment account. So there is a lot of uncertainty, just like you spoke. There is a lot of turbulence in the market. How could you elaborate on strategies like investors can stay focused on to hit those financial goals, even during these unknown times, or how you guys coach people through and our clients on these times? Like, what are you telling people and investors who are scared right now and who just the unknown and how to get to the long-term goal?
Well, I mean, what I would say, listen, like at the end of the day, we're still living in the most dynamic economy in the world. I mean, U.S. is pretty darn good, and we will figure this out. These things they may feel like they go on forever, but they don't. Like they get solved eventually. And the tailwind that we're getting from AI, like you can't forget about it. Really, like it's easy to right now. But it remains true today. Like the best historical analog we got is mid-90s. And that is, and that was the last time we had a massive economy-wide productivity boost emanating from technology, which is, by the way, the only way you get productivity boosts in the economy is through technology. That was the last one. If you're lucky to get one in a generation, guys. We're in the middle of one right now. Don't lose sight of that fact. Like this is a game-changing sort of technology that is going to impact every company in every sector across the globe. It's massive. So that tailwind is still there. It hasn't gone anywhere. It's being clouded over right now because people don't know how to operate their businesses for the next month. But operating your business for the next year is obviously you have to embrace the technology and use it and figure it out. And people will do that, and that's going to really, really help things as we recover from this. But in terms of navigating it, I would say, listen, don't lose track of don't lose sight of some of these really good things that we've got going on. The consumer's actually in really good shape. Businesses are in still pretty darn good shape. The employment situation is still fairly solid, and this AI boost is a real thing. So those things are still there. They're just being subjugated right now and subordinated right now to this massive amount of policy uncertainty that we're being subjected to. But that's sort of step one. Step two is, to some extent, if you're not in protection-based strategies, I would kind of close your eyes and try to forget about it. If you've got a more than a 12-month time horizon, if you have less than 12-month time horizon, you might need to be doing some stuff because this might take a little while to resolve itself. But if you've got more than a 12-month time horizon, you can probably be trickling in more money here. You can probably start buying here at some point. If you are nervous and you don't know how to do that, then you probably do need to investigate risk mitigation strategies, risk mitigation portfolios, something that will sort of do it for you, so you don't have to think about it, and know what the expectations might be for the portfolio to the upside and the downside. So it's either understanding what your horizon is, understanding what the problem is, understanding what the solution looks like, and then developing a plan and to take action. If you need to move, change portfolio strategies, do it. But don't just changing portfolio strategies to just getting out of the market is not a strategy. That part is the only thing that we know will be absolutely damaging to your financial health, over the medium or long term. Changing strategies to sort of line yourself up better with with how you're actually reacting. The ability to sleep at night, the ability to stick through and stay invested in that strategy is super important. But that's something that financial advisors are obviously that's what they do. Not the only thing they do. It is something they do very well, though. And so use to lean on that expertise. Lean on that that experience, that expertise, and the wisdom to help figure out what's the right thing for me. It just can't be get me out.
Hey, Scott, I wanted to go back to AI because when I was out in North Carolina and met with your team, one of the things that you said was that you thought that the AI trade was like in the second inning. Can you go like to what you would recommend people do for the AI trade and what you think is actually going to happen with the stocks that are related to AI?
Yeah, I think the stocks are going to be changing and broadening out. And so in terms of like how to invest in it, the first and the easiest investment is just, hey, listen, just get me exposure broadly to U.S. tech kind of stocks, or even a little bit broader types of stocks. It is generally an equity investment, not an alt investment, not a fixed income investment. It's got to be an equity investment because that's where you get the leverage out of the productivity gains that drive margin improvements and everything else. More specifically. We're coming out with an active ETF that's going to be kind of focused on some of this stuff. There are other ETFs that focus on the AI theme. You can put some of your portfolio in something like that. Just understand what the investment strategies are for those, because those can be very, very wild and very good in terms of like the way they think about the way you invest in AI. So I just suggest that we take a little bit of time to understand what that is, make sure you agree with it. The approach that we're going to be taking is one that identifies essentially 4 different regimes, or 4 different kind of types of AI, of like AI related stocks. You start with essentially the hardware part. So think NVIDIA and chips. You move out a little bit to like a little bit broader that. So think like cloud infrastructure, things that, the infrastructure parts of the economy that you need in order to power and train these models and actually use them in real life. The third component is companies actually really use AI in order to leverage AI in order to really drive productivity gains in their businesses, really transform the way they make money and everything else. And then the fourth group is kind of like one more generalization from that. It's like a little bit broader application of a sort of AI, and not quite specific to the exact business line, but just like I use it in part of my business. So those 4 sort of themes, like the hardcore infrastructure, like just the literal chips types of play, that a little bit broader, like I need chips, but I also need like cloud, and I also need some other stuff in order to make this stuff work. The third part is being, hey, listen, I need this, like I'm really using the technology to drive my business, and the fourth is I'm using the technology in part of my business to help me make marginal improvements. Like those 4 kind of classes of companies are really kind of how you think about investing in any sort of emerging technology theme, but especially AI. It does. I mean, I'll be honest, it takes a fair amount of expertise and time to figure those things out. I've got one person, I'm not gonna say dedicated to it, but it's probably half his time, like all day, every day, is figuring this stuff out, tracking it, making sure it's right. And so either I would say leverage things like people like us or people or other companies that do similar types of things. Just understand the product that you're investing in, like how you choose to do it.
Scott, as we come to an end here, one, we appreciate your expertise. This has been awesome for us. But I just want to close with a question. What's one financial principle you wish every person really understood? Thinking pretty broad base. So we got a wide customer base.
I mean, you guys have probably heard this a lot before, but look at the miracle of compounding is a big deal. I don't think that people really get that. That's actually what I'm trying to teach my boys right now. The daughter's
Me too.
A bit too young. She's started investing a little bit. But I bet I just put a little spreadsheet and just said, if you start with $1,000 today or whatever, and you get these types of returns, you're 17 years old, you're 15 years old, like here's what it might look like when you're 40 or 60 or 80, and just a simple compounding exercise, like you just see their eyes go like this, like it's almost incomprehensible how powerful compounding is until you really kind of look at it and see it in an example. So, I would say just the compounding nature of returns that you can get from longer term investing is, I think is underappreciated, but probably the biggest difference between the level of underappreciation and the importance of it to your long-term financial health and the amount of gains you can get out of it is probably the widest discrepancy of any sort of financial concept that at least that I'm aware of.
I love it. Back to the basics.
Yeah. Time is money.
Invest early.
Well, Scott, we just appreciate your time so much. We have a great partnership with Horizon Investment. You guys do a lot for our clients, and your expertise is unmatched. So thank you for talking about the uncertainty, but also the long-term and AI and everything in between. We greatly appreciate your time. This has been excellent.
I really appreciate it, guys. Thanks very much.
Thank you, Scott. Go
thanks,
Tar
Scott.
Heels.
This podcast is produced by Spin Market and Digital. Located in Fort Dodge, Iowa, Spin Market's highly skilled team can help you increase your market by updating your website, improving SEO, designing advertisements, and producing podcasts that will grab the attention of your market. Contact Spin Market today for all your digital marketing needs at digitalagent@spinmarket.com or call us at 515-302-8026. And to learn more, visit our website at www.spinmarket.com. That's digitalagent@spinmarket.com or 515-302-8026. Or visit our website at www.spinmarket.com.
Let's do a little dollars and cents.
Dollar bills, y'all.
Why should you care about the 10-year Treasury? And this is something probably not a lot of people are thinking about, is what is the 10-year Treasury doing, unless you're in the economic or financial world. But it really does have a huge impact on everyday investors. And first and foremost, and talking about this recent market volatility, we really saw, especially last Thursday and Friday, we saw the 10-year Treasury actually dip below 4% again for the first time, I think since October of 2024. So I believe that's what it is. But yeah, you can fact check me. But main reason is, especially 30-year fixed rate mortgages, they are heavily influenced by the 10-year Treasury. So we see that Treasury go down. Generally, that's going to have an impact on the 30-year fixed rate mortgage, in which, I think I was just talking yesterday, a lot of people who bought in the last 12 months, 18 months, they're paying 7% or more on their mortgage. And I do think, I think it was about 6.5 before kind of the drawdown is what the average was. But I do think, if we continue to see that, that float around that 4% range, we are going to get some relief on the mortgage side. Second, it does really have a snapshot. This is kind of maybe the scarier piece of the 10-year Treasury, but generally, it's a good market indication of where we're kind of the outlook for the next 5 to 10 years. And, rising yields tend to mean, investors are expecting strong growth. Now, we've seen yields retract a little bit, which it happens when you have market volatility because people are taking money out of the market, going into treasuries, which are then driving yields down. And sometimes that can be a recessionary signal. Not always. It just kind of depends on, where we're at in the market cycle. And then third and lastly, this is a little more indirectly, but it does have an impact on student loans, credit cards, and car loans. A lot of consumer-based lending activity. The 10-year Treasury will either have direct or indirectly have an impact on that. So that is something that's kind of been a bright light, I would say, out of the pessimistic market the last 3 or 4 days, is we have seen some relief on the 10-year Treasury.
Cool. So for our listeners, explain what is the 10-year Treasury? Like just in layman's terms, what is the 10-year Treasury?
Yep. So it's a basically a government bond that funds a lot of the functions of the government. So a lot of our treasuries are bought by institutions or other countries. So it's money going in, or it's money, we're raising money. Sometimes say we need to raise money and we're going out and selling those bonds, just like our local government would want to build a school and they're going to raise $40 million. They can do, the federal government, the Treasury is the way the federal government does that. And there's auctions weekly on either existing or and then there's also an open market for, you can go and buy treasuries. Individuals can buy treasuries. So, but yeah,
and it's what interest rate they're going to pay on that 10-year Treasury that you were to buy today. If you bought a 10-year Treasury, obviously I get 4.1% for the next 10 years on that money that I borrow to the government, basically.
Yep.
A lot of great information today. Cole J, tough to beat Scott though. Scott, he touched on, I think, a lot of hot topics right now: market volatility, the economy, what to do in these situations, how to remain in long-term based strategies and goals. The AIs, I think that's a hot topic. So I would love to have Scott come back on again, because I feel like we could have talked to Scott for hours. I mean, his story, his schooling, his 16-hour interview,
Russian economics, right?
Yeah, well,
that's
and
interesting.
if you want Scott back on, leave a comment or like this podcast, because I definitely want to have a round 2 with him. It was too short, but I think this is very relevant to our listeners right now that need to kind of hear some of this stuff.
You can look him up. He's been on a lot, like we were saying, he's been on a lot of publications, different interviews, things talking about, especially around market volatility, because their strategy is somewhat of a risk mitigation strategy, and a lot of insights, and then I'm sure he's got some great stories from the hedge fund world.
I was just going to say, I would love to hear the story about how he just like, then I started a hedge fund. If people know what a hedge fund is, you don't just start a hedge fund. It's not like something you just do all of a sudden.
And I had to sue my partner, and then I took my hedge fund into Horizon.
This guy has been through, obviously the 16-hour interview, the different companies that he's worked for, and started his own hedge fund. He's been through a lot of turns. And one thing that he said to me when I was out in North Carolina was, I was there during the .com era. I was there during the 08. He's like, this whole AI thing he goes, we're just in the second inning. And that's why I try to get him to elaborate on that, because I want to hear more about AI, because he's like, if you're not in AI, if you're not learning it, like you got to get in it. It's just like when computers came out and people that rejected them wouldn't do it, or iPhones. He's like, this is the next wave. And I think of my father that had a flip phone for 10 years after I got an iPhone, and then he finally got one, and he's like, wow, it changes your world, basically.
I'll give you a real life example just recently of, I'm on one of our foundation meetings. We were doing a Zoom or something, and we recorded the meeting, and we had AI do
the notes,
do the basically the recorder's notes that are then for board approval, right? Put it in, summarize, and then also send out a summary meeting to all the board members after, all done through AI, recording, listening, bullet pointed things out or what needed to be in the agenda.
Very
just
powerful.
think of it like, obviously there's someone's brain power is normally going to that, but you just click a button, you can have your conversations back and forth, and it's like, hey, there's someone doesn't have to spend the time. So now, on the other thing, I think it could cause us to be lazy, right?
A little less gratification.
Not do things. But I really think of, like he said, I just think of all the business applications from an efficiency standpoint of how many things that is going to save people time in the future. And businesses, like, they don't have to have a certain position because, or maybe 10 positions, because boom, we can do it all automated, or AI can use, we can use AI to get that done.
Yeah, Scott was a full of knowledge. Please share this. You got to evolve with the times, evolve with the investing strategies, evolve with AI. It's one of those things, the more you fight against it, the longer it's going to take for you to get into it. But so this is coming out Friday, April 11th. So just so you know, we have our 5K, 1K, April 13th, Fort Dodge Country Club.
Sign up.
Still sign up. You can come that morning and sign up if you're like, hey.
Yep, walk right up.
Yep. Pre-check-in, 8 a.m., 1K, 9 a.m., 5K to follow. You don't have to run. I think people
bring the kids out. We want kids. We want a lot of kids out there.
Family-oriented, 2 great causes, Cancer Connections. What is it called?
Child's Cancer Connection.
Thank you. 2 great causes, Child Cancer Connections, Fort Dodge Junior Golf Academy. Both organizations focus on helping children, and we want to see you there.
And 100% of what we raise will go to those 2 charities.
Yep. And it's just going to be some beautiful Iowa weather.
Weather's supposed to be gorgeous. 78's the forecast as of right now.
Morning run on Sunday.
Yep.
So also March Madness just wrapped up. So this quote is Paige Becker's. Glad she got her national title. Gino 12th all overall. Let's go.
Got the dub.
Let's go. Some people play the game. Some people love the game. But I think I live the game. Paige Buckets.
Go Cubs.
You've been listening to How to Money with Cole & Cole, the podcast of Full Swing Financial Planning. To learn more, visit their website at www.fullswingfinancial.com and follow them on Facebook and LinkedIn.
For now, I'm Cole.
I'm Bailey.
And I'm Cole.
And we'll see you on the greens. 4!
Security and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC.